everyone. It's Larry Kotlikoff back with Economics Matters. I'm delighted to have Gene Chatzky with me. Gene and I go back a bit. We're buddies officially, I think.
I think
We
so.
spent a lot of time talking about personal finance. I've been dying to have her on the podcast since I started it back 3 years ago. I've had a lot of other personal finance journalists, but Jean is really one of the top people we have in the country in this area. She's uh, worked with the Today Show for years. She's now AARP's personal finance ambassador. You can read her columns at AARP. That's not an easy assignment to get, but she's had lots of difficult assignments to get that she's nailed over the years. She's CEO. I guess her one of the biggest claims to fame is that she started and is CEO of the multimedia company, Her Money. We're going to want to talk a bunch about that because when you go to hermoney.com, it's got all kinds of interesting, important things for people, not just women, but people in general to learn about personal finances and all kinds of interesting articles to read that are coming out at a very rapid clip. You have quite the team of writers there. Anyway, Jean was born. I'm going to mostly have her tell us about her, okay? But in a second. But I just want to give it just a general background. She's from Michigan. She was born in Michigan, raised in Wisconsin, Indiana, and West Virginia. So she's solidly, I guess, Midwest. Uh, she holds a BA in English. Went, as did I, to the University of Pennsylvania. So she has a degree in journalism at Penn or
Nope, just English.
just English? Oh, great. And her dad was a college professor. What did he profess?
He professed. He taught communications at Wisconsin and then at Indiana, and
Uh,
then he left teaching and went to run television stations. So I had a little bit of that in my background too, growing up.
so yeah. What about your mom?
My mom was quite remarkable. We lost my mom about a year ago, and
Oh,
we moved for my father's career, but every time we moved, my mother reinvented herself. So she taught second grade in Center City, Philadelphia, after getting her um, BA at Temple. And when we were in Detroit, she taught in an inner city school and then stayed home with me and my brothers for a few years, but went back and got her master's in educational psychology when we were in Indiana. When we were in West Virginia, she taught statistics on the college level, which is insane. She ran a gifted and talented program for high school students, and eventually my parents moved to DC. My dad worked for the National Association of Broadcasters, and my mom was a librarian at Capitol Hill Day School.
well, fantastic. So now Jean's had quite the run through journalism, but before she started into journalism, you worked with Dean Witter on the equity research. Well, you
Yeah,
actually
that
started your career with working women. Why don't you give us your like a tour of your career rather than I kind of chopping it up? Just
so yeah, so I went to college and I decided I wanted to be a journalist, and I was fortunate enough to get a job when I got out at Working Woman magazine, which doesn't exist anymore, but was a crazy amalgam of a magazine. It had everything from fashion and food to finance and career advice. And I was the assistant to the business editor. So I did a lot of phone answering and coffee getting and errand running, but I also got to write some stories on companies like The Gap and Nike, and I liked it. I liked covering business, and so when I was ready to leave Working Woman, I wanted to go to a business magazine. I want what I really wanted, because I had a colleague who had come out of the fact-checking program at Forbes, was to go to Forbes, and Forbes thought that Working Woman was a joke. And I did eventually get an interview at Forbes, but the chief of reporters told me I had really no business working for his magazine and I should go get an MBA. But I didn't really want to go back to school. So instead of getting an MBA, I decided to look for a job on Wall Street. And I got hired at Dean Witter as an associate in equity research because what I figured was that whenever I was writing a business story, I was calling research analysts and they wrote reports that were pretty much like stories that could have appeared in a business magazine. And if I could on their dime learn how to read financial statements and really understand how companies and stocks and other investments work, then Forbes would hire me, which it took 2 years, but that's basically what happened. I went back. I got hired as a fact checker reporter at Forbes, joined the startup team at Smart Money magazine from there. And Smart Money was a very well-funded startup. We had two corporate parents, the Hearst Corporation and Dow Jones, which meant that we had enough money for PR. And the PR guy at Smart Money got a spot on the early morning version of the Today Show for our editor-in-chief, a guy named Steve Swartz, who's now running the Hearst Corporation. Um, Steve did it once, came back into the office complaining that he had to get up at 5:30 in the morning and that they didn't even have any coffee, which, by the way, was true. And so the spot just started rotating, and whoever had a story would go on and talk about that story. And I went on one week and they liked me. I mentioned I sort of grew up in a television station. I wasn't um
Camera
as
shy, right?
yeah, I sort of knew what it was like to talk to an anchor. And they asked me to just come back. So I did that every Monday morning for 3 years.
Cool.
Um, and then got picked up on the Today Show where I worked for 25 years. Um, did a couple of years of radio and television for Oprah, um, wrote a bunch of books, started Her Money, and
Right.
have been producing the Her Money podcast ever since.
We should make a too short a shrift of 14 books. You've written 14 books. If everybody goes to Amazon or Barnes and Nobles or independent, there must be an independent. You go to your bookstore and the local bookstore, don't buy if you can, and just look at 14 books by Jean Chatzky that are full of wisdom about personal finance. And Her Money is a really major, I think, contribution to
Thank
uh,
you.
financial literacy, financial uh, decision making to the country. And tell us about, you started that around 2018 or so,
Hmm.
or
Yep, around 2018, we started with a newsletter and a podcast and a website. But what I'm most excited about today is the coaching that we're doing. So a few years ago, we launched one coaching program called Finance Fix. It's a small group coaching program where we take people through a 6-week process with an accredited coach, and they figure out with our methodology how to spend less, save more, pay down debt, and essentially get their financial act together. And we've just launched a pre-retirement version of that program, which has a checkup built in to figure out if you're on track to meet your retirement goals. And our third coaching program is something called Investing Fix. It's basically an investing club for women. We've got hundreds of women learning about investing and building a group portfolio. It's a model portfolio together, but I teach this myself every other Monday night with Karen Feinerman, who is a professional investor. She's on CNBC's Fast Money. Um, and we're having an amazing time. We're learning a ton. We're teaching women how to think and talk the language of investing. and bringing them along with their confidence. With the portfolio that we run, it's a model portfolio, but it has beaten the S&P. And I don't choose these stocks. We present 4 different investments every month. Our members, some tee up their own ideas. They vote on what gets added to the portfolio, and
Sounds like great fun.
it's great fun. And I know a lot of our members have done well because we were pretty early to NVIDIA. We were good and in early on United Rentals. So, they're making money and having fun at the same time.
That's great. So her money, we don't have his money, or do we yet? Maybe that's coming. But tell everybody why women are different from men when it comes to financial decision making, and why they need to have their separate website.
So two reasons. Women are different when we look at the statistics, right? We earn less. I can't get that stubborn wage gap to budge. We there we're still the ones who take breaks from work to care for kids, to care for older parents. That became so apparent in the pandemic, even if it had faded a little bit before that. But somebody had to take a step back. It was going to be the woman. We end up with less money in our retirement accounts. We end up with fewer Social Security credits, as you know so well.
Right.
And then we go on and we outlive men by 6 years. So we have less money and we need to make it last a longer period of time. And that means a different set of strategies. So women need different advice for those tactical reasons. There's my friend Jane Bryant Quinn, who is
My friend too.
your friend too, and
Jane
the
Witter.
best personal finance journalist ever, right? I mean, Jane Bryant Quinn, the best.
The queen of financial
Yes.
plan. Yeah.
And she used to say stocks are not pink or blue, they're green. Money is not pink or blue, it's green. She's right, right? If an investment that is good for a woman is going to be an investment that's good for a man, but we need different strategies. The other thing we need is a safe space. We need a space where we feel as if we can ask all of our questions without being judged. And I've been a speaker on the speaking circuit like you for many, many, many years now. And what I noticed was that when I would go out and speak to a group of all women and I'd get to the Q&A portion, it could have gone on for an hour or longer, right? Women want to tell their stories, they want to share, they don't feel shy talking about themselves and asking their questions. When I'm in a mixed group, that doesn't happen. And which is a shame, right? Or you have to really, really nudge it to get it going. And so it was that experience that taught me that I wanted to develop this safe space for women. And I see it every day. One of the things that we have at Her Money is a private Facebook group. We've got more than 20,000 women in it helping each other with their financial questions every single day. These are just women who give each other smart, honest advice. And it's amazing.
Well, okay, now I get it.
How financially secure do you feel? Imagine a tool to help you make smart financial decisions. A tool that factors in all your financial data and shows what you can safely spend every year for the rest of your life. That tool is Maxify. Powerful, accurate, and easy to use. Developed by Boston University economist Lawrence Kotlikoff, Maxify takes the guesswork out of financial decisions at every stage of life. Maxify calculates what you can afford to spend now and throughout retirement. And you can run what-if scenarios to see how your finances might change by taking a new job, buying a home, or downsizing. Knowing the impact before you decide lets you make smarter decisions so you can finally enjoy financial peace of mind. Are you ready? Visit Maxify.com today to start planning. That's Maxify with an I. Maxify. Maxify.com.
And how do you think this advice is different for women versus men?
We help them get started and we help them keep going. Do we advise them differently than we would advise men? There are some things that are of more importance for women when we look at the end of a woman's life, right? She is most likely to, if she's married, to take care of her spouse, and then who's going to be around to take care of her, right? Those that presents the need for certain strategies. If she's going to be the one to stay home, we look at ways that she can protect herself, with savings, with investments, with a prenup, if a prenup is necessary. But I think mostly I feel it's our job to give women the confidence they need to start investing and stay invested. When we look at the statistics on the percentage of money that individuals have put to work versus kept in cash, what we see is women keep more money in cash. We are great investors once we get started, but sometimes we're late to the party. And being late to the party when you need your money to work that much harder because of all of those demographics that I laid out before, that's not a good thing.
Yeah, well, one trick that I've come up with in my software is called upside investing, where you invest, and this may be of value to our listeners. I know some of our listeners have already heard about this idea, but it's implemented in our software, which is you put a certain fraction of your assets in inflation index bonds and a ladder of TIPS, Treasury inflation protected securities, and you spend out of those, and you spend in a sustainable way so that you're always and then the rest of your assets you have in stock, like the S&P at a very low, and an index at a very low cost. But that money is kind of treated as lost until it's found. So you specify in the software, I'm going to let that money ride for 15 years, and then I'll gradually take it out over 10 years. And then as I gradually take it out, depending on how well it does, I'll buy more tips, and that will let me have a higher floor to my living standard. So we're setting a living standard floor and an upside. That's why it's called upside investing. So that's one way I think that people can safely, the idea of not being in the market scares people, and the idea of being in the market scares people because they want to have a living standard floor. They don't want their living standard to drop. And this is a way you can have kind of both slices.
Yeah. Well, I mean, I think what we're seeing over the past, I don't know, 5 years maybe, is this increased discussion in making sure that you've got an income solution, right, for
Right.
your retirement, that making sure in whatever form it takes, whether it is this tips ladder or whether it's an annuity or whether you're fortunate enough to have some sort of pension income, or whether it's, the very foundational building block of delaying Social Security, right? That's just in most cases the table stakes. Um,
Right.
it's knowing that you've got a paycheck that's going to continue, that will at least cover your fixed expenses for as long as you live.
Right. And also and also kind of working longer to make sure that you don't have to rely on these other sources, which may not be big enough. So this idea of delaying retirement, a lot of people come to a point where they decide that they are, they deserve to retire. I'm old enough to retire, and other people are retiring, and I've worked long enough. Well, a lot of people are retiring to the point where they're going to live longer than they actually worked, and they don't quite, because they're sure they're going to die on time. I don't know if you see that, you hear that, but I hear that a lot in interacting with people. Oh, I'm not, my life expectancy is this, therefore I should take Social Security right away. Because if I die and I don't get it, I'm going to be regretting it. Of course, I'll be in heaven. I'm not going to regret much in heaven, right? But
Well, I think people have this, and you and I have talked about this. People have this massive misunderstanding of the concept of life expectancy, right? That they look at the average life expectancy of a 65. Well, first of all, they look at it at birth, which is a mistake. You got to look at it from age 65. You can't look at it at
yeah,
at birth. But even at 65, if people look at 84 as the average life expectancy, they think, oh, that's when I'm going to check out. They don't realize that means half of all of those 84-year-olds are going to keep on going. And a very good chunk are going to hit 90. A smaller but still significant chunk are going to hit 95. And the number of people who are living past 100 is growing every single decade. I mean, it's
that's the
just,
fastest growing demographic group
yeah, it's
amongst
insane. And
centenarians.
it's lovely. But
Yeah,
you've gotta plan on living that long, which is why I mean I have a problem with financial advisors who when they run the calculation don't put 95 or 100
yeah.
into the
Our
age
default
box.
is we don't even use the word life expectancy. We just have maximum age of life in our software, and it's 100. You can make it higher, you can make it lower, but that's our default.
Yeah.
So 100% with you. How do you find that you have some interact with some women who uh, can't give up investing in them? They have enough money such that if they were to invest, let's say, in tips or some other secure, pretty secure asset like a rental real estate property or something that was going to be protected against inflation, uh, that they have a lot of money in the stock market, and moving out of the stock market is a really tough thing for them to do. That they're kind of addicted to, at least I found this. I've been doing concierge consulting of late with uh, people using our software. And some of it's with financial advisors who realize that they really don't like their software. They're happy to use it on other people, but not on themselves. But then I've got other people who have been working on Wall Street for a long time who are actually uh, really well endowed, but getting out of the market for them, they're super worried about the market crashing. On the other hand, getting out of the market is a huge no-no. They can't do it to the point that they're depressed about and anxious every day in their late 70s
Mm.
with a lot of money, and they can't pull out of the market and go into something safe because they might miss out on the upside.
Well, that's exactly what I think it is. I mean, there's a retirement researcher, I'm sure you've met him, named Wade Pfau. Do you know Wade?
I know, wait, I've had him on the podcast. Yeah. Mhm.
Okay, so Wade has this RISA scale, which basically looks at retirement. It looks at your personality as an investor for retirement. And one of the factors
Mhm.
that he weighs in helping people figure out where they should put their money is FOMO. It's sort of, are you a maximizer or are you a satisficer, as Barry Schwartz or Schwartz from Swarthmore used to say. Like, are you going to be okay if the market continues to go up and you weren't on that ride? Or are you going to feel really, really terrible about that, even if you have enough money to accomplish all the goals that you had previously laid out for yourself? And I think people who like you have described, and I haven't seen this yet, but if you're seeing it, I'm gonna get into my Facebook group and I'm gonna ask the question. Um, it I think that people who have been in the business of money, um, and especially over the last 20 years where it's been this, basically a perpetual bull market, um, have really gotten addicted to the high of growth.
Yeah, they're definitely, that's why this upside investing is, hey, keep some money in there, but just don't count on it. Only put what's in the market, at some point, secure your living standard. You're not spending, the program says spend, you can spend here, they're spending down here. Say, well, let's run the program setting a spending limit. And the rest, it's actually, there's no upside for you because you're not going to spend more if it goes up. There's
Well,
only
that
a downside, which is your living standard could drop. And so why not spend out of it? It's really your kids' money at this point. And
yeah.
are you playing around with it?
The
Do your kids want you to risk their inheritance is the question.
the people that I worry about too are those people who have worked really hard their whole life, who have amassed not a nest egg like you're talking about, but a nest egg that is big enough to support them, to give them a retirement that they can really enjoy, and they're not spending, right? I mean, and
Oh yeah, we've seen that too. Yeah.
right, they're not spending. They don't want to spend their principal. My mother was a pretty good example of this. I mean, uh, she had amassed a nice nest egg. Look, she lived, she traveled, she did what she wanted to do. She went shopping when she wanted to go shopping. She definitely didn't deny herself, but she could have done more. She could have, and I'm sure there were things that she didn't do because she was just like, oh, I don't want to pull that money out of my principal. I mean, we train people, you put money away, you put money, you accumulate, you accumulate, you accumulate. But when we get to the point where the switch flips, you're retired, and now you have to decumulate, people just can't do it because they don't want to see that balance go down.
Yeah, I've seen this. I mean, I just had somebody the other day who's got a couple kids and uh they have plenty of money more, and then we had to set the spending limit in the program because it was clear they weren't spending what the program was saying, much less like half. And I said, well, you've got 10 million bucks. You're 85, you and your wife, that age. Uh, got like 15 years to go, most likely. Well, in the, let's assume that. Uh, you're not going to spend this money. It's really your kids' money. What about making gifts? And so the gentleman's thought about it for a moment and said, well, I think we could probably we have 3 kids, and a couple grandkids, we can make $5,000 a year gifts. I said, what about $50,000 a year gifts? And it kind of a light bulb went off because I said they're in a lower tax bracket, so they can accumulate the money at a lower, because this was money not in a retirement account, this was in a non-retirement account. So if you what kind of things do you see? I mean, I'm seeing these kind of psychological problems with people thinking about money, uh, and just wondering what
It's
you
all
think
psychology,
about it.
right?
Yeah.
It is. It's sort of it's all psychology. And I do think it comes back to that question of whether you feel like what you have is enough for you. Um, and I spoke to a really interesting researcher. So I'm working on a new book
Yeah, tell us
called
about the new book.
I'm working on a new book. It's called The Forever Paycheck. It'll come out in the fall of 26. Um, and so I've been looking at a lot of these different issues, but one of the questions is, are you one of those people who are just chasing wealth for wealth's sake? Or are you are you goal oriented? Are you trying to check off the items on a finite bucket list and you kind of know what those are and how much it'll cost to sustain you
Mhm.
year after year and pay for some long-term care should you need it, right? Let's just establish that you've got a cushion for long-term care. If you're the former, if you're chasing wealth, it's really hard to get people to make gifts. It's really hard to get them to let go because they haven't convinced themselves that they have enough. But if you're the latter type of person, and it sounds like that's who you were talking to, um, it is that's a very, very smart strategy. And I think a lot of it comes down to sort of a balance of nature and nurture. So we talk a lot in our coaching about your money type and your money story. So your money story is how you were raised. It's the feelings that you that sort of got into you from the home that you were raised in as a child. And if you were raised in a home where money was a stress or money was an issue or there wasn't enough money or your parents had a dysfunctional relationship about money, like you took that in, and unless you dealt with it in therapy with a really good psychologist, you never got over it, right? It is still bogging you down to this day. Your money type, and we have a tool on our website. You can just go to moneytype.me, or you can go to her money and you can take our money type diagnostic. Is That's innate. That's how you're wired. That's how you can have two kids who are close in age, who grew up in the same exact household and are completely and totally different about money. And what we find is that there are a handful. There are five different money types. And you need different strategies based on how you're wired. So if you're a nurturer, which is one of our types, and you are wired to just take care of everybody else before you take care of yourself, well, you got to figure out some way to shut that down, or you're not going to end up with a solid foundation in retirement. If you're a producer like me, you tend to you're pretty good at making money and you really like making money, but you have to be pushed to take risk. Um, I let my financial advisor push my asset allocation a bit because I know that I'm wired to be pretty conservative.
Mm.
It's important to understand all of these things about yourself in order to enable yourself to be better at managing your own money. These are not things you can unsee or unlearn or get rid of, but by knowing them, you can help yourself deal with them.
Want more money, less risk, and a better life? Buy Money Magic, a new book by Lawrence Kotlikoff, Boston University economist, personal finance expert, and best-selling author. Whether it's education, career, marriage, housing, investing, retirement, Social Security, IRA, or 401k decisions, Money Magic delivers scores of secrets to raise your living standard. Financial journalist Jane Bryant Quinn says Money Magic is a must-read. Nobel laureate George Akerlof says Money Magic is quite probably the best financial advice book ever written. Financial guru John Malden says, "You'll love this amazing book. It's full of wit, wisdom, and startling paths to a better financial life." And columnist Scott Burns calls Money Magic a funny, brilliant read, offering wildly powerful, unconventional choices that can literally change your life. Get Lawrence Kotlikoff's Money Magic today at Amazon, Barnes & Noble, and independent booksellers.
So if so talking about, let's say, maybe your own personal financial decisions on investing, are you investing in individual stocks at this point? Or the advisor, you mentioned an advisor, so
I have an advisor. I'm mostly in ETFs and indexes and low cost investments that I've been in, munis and some other, bonds, mostly in that kind of a portfolio. So as I said, I grew up at Smart Money Magazine and Money Magazine, and trading individual stocks, trading anything that we were writing about was verboten. So I grew up as an indexer. I do these days buy some of the stocks that we put forward in our investing fix program. I'm learning along the way. And I'm not investing a ton of money, but I'm having fun with this. I'm having fun learning about these companies. It's probably I don't know, 2% of my portfolio. So it's like what I've got in crypto, right? It's not a big deal, but um it's something that I'm enjoying.
Mhm. So you mentioned crypto. Crypto is something you think everybody should
Nope.
know?
I don't think everybody should do it. I think, first of all, I don't think you should buy anything where you have not gotten a bit of an education and have at least tried to understand it. Um, I I don't think particularly now with, there's that saying, don't fight the Fed, right? I think with everything that's going on in Washington with the Genius Act and the support that this government in particular is throwing behind crypto, I don't think you fight that. So I mean, I've been in it for a while, but again, in a very, very small way. It's money that if I lost it all, I could still sleep at night. Um, but when I don't know, a number of years ago, I did a podcast about it, and my guest on that podcast suggested that if you want to dip a toe in, you dollar cost average just like you would into anything else. So I opened a Coinbase account, started buying a little bit every single month, and that's sort of how I have a little bit of crypto.
Okay. What about gold too? A little bit of gold?
We've got a gold ETF. My advisor has us in a precious metals ETF.
Okay. What about tips? Is that something you play with
I'm
or?
really interested in tips, and in part I'm interested in tips because I am for this book exploring different income solutions.
Mhm.
And so I need to spend an hour with you and truly understand them because I'm not great at tips yet.
Okay. Anytime.
Okay.
I'm yours.
How financially secure do you feel? Imagine a tool to help you make smart financial decisions. A tool that factors in all your financial data and shows what you can safely spend every year for the rest of your life. That tool is Maxify. Powerful, accurate, and easy to use. Developed by Boston University economist Lawrence Kotlikoff, Maxify takes the guesswork out of financial decisions at every stage of life. Maxify calculates what you can afford to spend now and throughout retirement. And you can run what-if scenarios to see how your finances might change by taking a new job, buying a home, or downsizing. Knowing the impact before you decide lets you make smarter decisions so you can finally enjoy financial peace of mind. Are you ready? Visit Maxify.com today to start planning. That's Maxify with an I. Maxify, Maxify.com.
So we're coming to about 45 minutes. Tell us anything you think that, you know, from your years of kind of writing and experience of talking to people, any kind of general advice for maybe different types of people, uh, maybe young women in their 20s, young women in their 30s, 40s, 50s. Maybe we can go through the decades here.
Sure. So young women in their 20s, um,
Maybe don't
do
borrow
your
for college.
best. What?
I would say
No,
don't borrow for college.
yeah, no, I was going to say do your best to live on what you make, right? I mean, I think the 20s is where the cost of living, and particularly for this generation, is just so expensive compared to the wage base, particularly housing. Um, do your best to live on what you make, to not rack up credit card debt, and to get started in your company's retirement plan. There was a story in the Wall Street Journal just today, and maybe it was over the weekend, but about how Gen Z and particularly Gen Z women are killing it when it comes to investing for retirement. They're talking about it, they're excited about it, but they've been helped in no small measure by the provisions in the Secure Act that allowed employers to automatically um, put
Invest
people.
them.
Not even the Secure Act. I mean, it was before that. It was 2006 provisions that allowed yeah, it allowed people to get automatically enrolled, automatic escalation, put them in a target date fund where they're going to be diversified and stay diversified and not have to rebalance. And I used to have these back and forth arguments with my husband about, was this too much Big Brother? And I would say, no, this is just the right amount of Big Brother. Give us more Big Brother, because it's people won't do it on their own. So I love that that system has been shown to work. In your 30s, um, look, I think I'm upset about the fact that this generation has not been able to get into homes. Um, I think owning a home is like having a supplemental savings account for retirement, because if you get to the point where you've largely paid off that home, you've got this chunk of money and you can use it for a house. You can use it to continue to live there. You can use it to pay for your long-term care. And I want my kids' generation to be able to do that. So I would say, in your 30s, start looking at what you might have to do to get into a house. My daughter and her fiance just picked up, left New York and moved to Charlotte because the cost of living in Charlotte is much more affordable than the cost of living in New York. And they granted, his company has a home base there, so it was an easier move for them to make. But they looked at the landscape and they said, we do fairly well for people our age, but we feel poor in New York and we don't want to feel that way. So think about decisions like that. In your 40s, you definitely want to be at the point where you are maxing out your retirement contributions, where you're maxing out your contributions into an HSA if you have one, and not using the money, but building a supplemental retirement cushion where um, you are putting money away if you can for kids, for their college education or whatever they decide they want down the road, because it looks like we're going to get a window for 529s to be used for all sorts of different forms of education, which is great. Um, 40s are also your decade where you really have to make sure that you're buttoned up estate planning wise. I mean, I'd love to see people do it earlier, as soon as they get married, have kids, have assets. But if you haven't done it by the time you're 40, it's time. And it's also the time to have a talk with your older parents about their wishes and what they want. 50s, pre-retirement checkup time. That's what we're doing at Finance Fix. You got to look and make sure that you are on the road to solving for your own retirement goals. And if you're not, then as you said, Larry, you tweak the levers. You work a little more longer, you save a little more, you spend a little less. I mean, the one thing you probably don't want to do is just tweak the risk profile of what you're investing in to try to gain ground that way. That's typically a mistake. Your 60s, I would say keep working. I'm 60. I am not retiring anytime soon. I think it keeps you happy, healthy, engaged, and it keeps money flowing into your accounts. And after 60, you can take care of people. They'll turn to you.
I agree with that. I mean, my retirement plan, of course, I have the luxury of being a tenured professor, but my retirement plan is to retire 1 year to the day after I die.
There you go.
Yeah.
That I think that's a good goal.
Yeah, but I've got a great job, and I get to do things like have this fabulous conversation with you. And so everybody, don't wait for 2026 to read Jean Chatzky's wisdom. Go to AARP, read her columns, go to hermoney.com, read her columns and other people's columns, participate in in all the discussions. If you're female, if you're male, talk to
Lurk.
lurk, exactly. But just read her books, read the other 14 books that are already sitting there to be read. And, you know, and then try and put yourself outside of your own kind of look at yourself from a distance, so to speak, to analyze these hangups that you may have developed in your day. Your parents might have lost a whole lot of money on the market, and therefore you're panicked about being in the market. You've never been in the market. You've got your money cash, and inflation is eating it up in real dollars. Or they might have made a killing, but the stock market has just peaked, right? And maybe it's time to get off that gravy train and make things secure. And then think about who you're investing for, right? Or is it yourself, or is it your kids? Are you putting them at risk? Do they need help now as opposed to when you're 100 and they're 70? So all these things are worth kind of focusing on from different perspectives, not just your own. I would say might be a good summation here of the kinds of things you've been saying. So Jean, thanks a million. We will hopefully do this again soon, certainly when your book comes out.
Thank you.
Come have you back and talk about it in detail. So this is great. Thanks again.
That sounds great. Thanks for having me.
Thank you.